Okay. Thank you very much for coming in and joining us this afternoon. I'm Jerry Firestein. I'm the Senior Vice President here at the Middle East Institute. And I'm pleased to welcome you to today's panel to discuss the progress and pressing challenges facing the Gulf countries' economies. We're pleased to partner with the Atlantic Council Global Energy Center for this event and to have its Associate Director, Bina Hussein, as the moderator. Today's talk will delve into the research of MEI scholar Jean-François Seznec and his co-author, Seznec and Mosis, whose new book, The Financial Markets of the Arab Gulf, Power, Politics, and Money, delves into the recent history of Gulf oil markets and their impact on social and political developments in those countries, as well as the impact on the global economy and energy market. The book is available for purchase via Routledge. It's on Amazon, presumably, yeah, so you can get it from Amazon. Many thanks to Bina Hussein for moderating today's discussion. Bina is an Associate Director with the Atlantic Council's Global Energy Center, having joined the Council in 2013. In this capacity, she focuses on oil and gas developments in the Persian Gulf and Middle East, as well as economic diversification in the region, manages the agenda for the Council's annual flagship initiative, the Global Energy Forum in Abu Dhabi, and runs the Women's Leaders in Energy Fellowship. Previously, she worked for the United Nations Development Program as a junior consultant in the private sector development program in the Kurdistan region of Iraq. From 2009 to 2011, Bina worked as a social worker for documented refugees and as a paralegal for undocumented immigrants at the Dutch Refugee Organization in Amsterdam, the Netherlands. So a little bit of a career shift there for you, Bina. Thank you for joining us to discuss these complex and challenging relationships. Before I turn it over to Bina, please remember to silence your cell phones. However, we do encourage you to join the conversation on Twitter using the hashtag GulfEcon. Please join me in welcoming the panel.
Thank you, Jerry, and thank you to the Middle East Institute for hosting us here today. It's a real pleasure for the Atlantic Council to be collaborating with you on this important book launch on the financial markets of the Arab Gulf, power, politics, and money. I read the book with great interest. As we discussed before, I did not fall asleep. So we have with us Jean-François Seznec, who's a scholar with the Middle East Institute and a senior fellow with the Global Energy Center at the Atlantic Council, and Seznec and Mosis, senior analyst with S&P Global Platts Analytics. Welcome, and thank you so much for being here and taking the time to speak on your book. So when I read the book, it really provided a great historical overview of the establishment of the financial institutions across the Gulf and shares the evolution it has gone through due to the increase of revenue from oil and gas sector over decades. This book goes back, 5-6 decades at least. The authors provide analysis on the role of these financial institutions in the global market and how the Gulf countries are utilizing the different financial institutions to achieve a diversified economy. While economic diversification has been a hot topic over the past few years, especially after the fall of the oil prices in 2014, as Jean-François and Samer actually point out in the book, this is a concept that has been, in the works from the beginning. In fact, the Gulf countries have been aiming to diversify the economy for decades and actually established these financial institutions to support that goal early on. And we're talking about at least the 70s when it comes to the UAE and earlier on for some of the other countries. So we'll talk more about diversification in a moment, but first, let's discuss a little bit about the different financial institutions. You've got sovereign wealth funds, you've got stock exchange, you've got banks, you've got investment companies, et cetera, et cetera. Could you describe a little bit, and maybe Jean-François, you can start with that. Could you describe how the financial institutions differ between the Gulf countries? And perhaps, are there also some commonalities that they share?
Well, of course, like all financial markets, you have the central banks. You have the regulatory system is, of course, pretty similar in terms of names of institutions. But in terms of how the institutions work, they are quite different, even though these countries are very close to each other. They have a lot in common. They have oil. They have a lot of cash sometimes. But they use these institutions very differently. Of course, the monster institution, if you like, the big one is the Saudi Arabian Monetary Agency in Saudi Arabia, which is, in fact, totally different than the others. And one of the problems they have today, as we know in the Gulf, they cannot get a common currency going because the central banks don't agree with each other. Nobody knows who's going to be the central bank of the GCC, so nothing's happening. But the Saudi Monetary Agency for a long, long time was both the regulator of the banks, the issuer of the currencies, and also the manager of the funds. And in most of the literature today on sovereign wealth funds, you will see that they list SAMA, the monetary agency, as a sovereign wealth fund, which it isn't. By the way, I recommend a piece which Bina just wrote on the sovereign wealth fund at the council, which is excellent. You could see that. SAMA today manages $500 billion, a lot of it's kept here in Washington. But they like to control this in a very conservative fashion to protect the assets of the kingdom. On the other side, you have other central banks, like the Central Bank of Qatar, the Central Bank of the UAE, do not manage the funds. Those funds get passed on directly to real sovereign wealth funds, and that are very large and have totally different missions. So the Central Bank of Saudi Arabia is very powerful. But there is a big proviso. This is really changing by the day. And today there's a lot of pressure against the Ministry of Finance and the Monetary Agency in Saudi Arabia from the young guys who are trying to run the economy. Because of Mohammed bin Salman, they established the Public Investment Fund. They broke the Public Investment Fund away from the Ministry of Finance. It used to be part of the Ministry of Finance. And to show you how this works a little bit, over the decades, of course, the banks, like all banks in the world, run into trouble. And every time a bank in Saudi Arabia ran into trouble, they ran to the monetary agency for money. So the monetary agency would take those banks, give them cash in the form of, they would increase the capital, buy the capital of some of the shareholders, and basically become very large owners. And today, in Saudi Arabia, the state basically controls all the banks, except one. And what happened is the control of these banks is through the Public Investment Fund, which was the arm of the Ministry of Finance. But Mohammed bin Salman broke that arm, so to speak, and made it into a sovereign wealth fund. So today, the Public Investment Fund of Saudi Arabia owns basically all the banks in Saudi Arabia. So it's not nationalized or anything of this, but it is extremely strong. On the other side, the other central banks just merely control the balance sheets of the banks, and they see that they don't try to make too many mistakes and so on. So it's quite different in that approach. The state in Saudi Arabia is much stronger in its regulation of the market. And I think Samir might want to talk about how they control the stock markets and whatnot.
Oh, yeah, absolutely. I mean, I think, first, thank you for joining us here today. And it's a great opportunity to be speaking at the Middle East Institute in the Atlantic Council. I think one of the things that Jean-François has touched on, the professor has touched on very rightly, is that the sheer size of the Saudi Arabian market. When you look at Saudi Arabia as a country in the Gulf, its population is 5 times the population combined with the rest of the Gulf. We're talking about a very, very large market. And in that regard, when we start looking at the differences between markets in the Gulf, you will see that Saudi Arabian institutions and industries often dwarf that of other economies in the region. And this is one of the fundamental differences. And in that regard, we often see that in the capital markets and in the banking markets, you will see Saudi Arabia attract the most investment, attract the largest players, and in that regard move faster than its regional peers. When we talk about the banking sector specifically, when you look at the largest banking sectors, we're talking about KSA and the UAE, these are extremely saturated markets. Very high penetration and very low space for continued growth of the large number of banks there. And in that regard, you're at an inflection point. You're at a point where you'd expect to see consolidation, and that is exactly what you are seeing. It's a very crowded market, so much so that when you start looking at some of the players, the Islamic financial players, they're offering credit on everything. You can get an Islamic sanctioned loan for your washing machine, right? And that's not a joke. And in that regard, it's a very crowded space. And that is KSA in the UAE. And you'll see that some of the other economies, while they have the same kind of institutions, we're talking about Bahrain, specifically Oman, their banking sectors have actually shrunk in size since the 70s when you adjust for inflation. So what the professor touched on and what is true is that you have similar setups in all of these economies, but the growth has just not been parallel, has not been the same. Some of the important things that are consistent and are expected to remain consistent and are fundamental similarities: no taxes, the absolute free flow of funds. Take money in and out wherever you want to go. There's some changes to that around AML and in regards to money laundering, but for all intents and purposes, free flow of capital. And we're talking also on a negative side, there is the existence of moral hazard across all these markets. And that's what takes us firmly into capital markets. And again, the same thing is going on in capital markets, whereas you have the Tadawul in Saudi Arabia outsizing the rest of the region. That was 550 billion market cap, and just for reference, the Singapore exchange is about 680, right? And that Singapore exchange is nothing to sneeze at. So in that regard, the Tadawul is very large and growing. Other markets maybe have, in the UAE, Kuwait, have a handful of companies listed, no IPOs to speak of every year. So again, they're dwarfed. But what is common across all of these capital markets is this idea of government intervention to ensure and prevent bearish cyclical impact to common investors. So this started in Kuwait before the Sukhumenic crisis in the 80s and led to the Sukhumenic crisis in many ways, and we go into it in the book. But what is the most important bit is that you consistently see the government step in at times when there would be serious losses, and this lets investors believe that no matter what happens, I'll be safe. The government will take care of us. And that leads to very irrational behavior and leads to moral hazard. And we see that in all the capital markets across the Gulf up until now. Even now, there's research that shows that when you start to see bearish sentiment in this Tadawul trading, there is capital injection that, for what is likely government directed. And when you start thinking about steps forward, this commonality is one of the major things that stands in juxtaposition to where they want to be. You want to be in 30 years a fully developed liberal market, you can't have these mechanisms in play. So, and the core theme of the book, and I'll hand it back to the professor on this, is that up until now, these mechanisms of government intervention have been successful in reaching a specific level of industrialization and market growth. Moving forward, the next steps require that commonality, that tendency for government intervention shifts. And that's the real question. Can it and will it, right?
Yeah, I think one of the differences between the various markets is the various vision of the technocratic structures. In Saudi Arabia, the technocrats, the leaders of the Ministry of Finance, of the Saudi Arabian Monetary Agency, really had a vision as early as the 70s to industrialize the kingdom. And they really managed the financial flows to fit that image. For instance, very early on, with the increase of price of oil in the late 70s, 80s, and so on, the banks were extremely liquid in Saudi Arabia, and the first thing most banks would do is, what do we do with the money? And what they wanted to do with the money was, you know, invest, like all the other banks at the time, invest in Latin America, Eurodollar loans, and so on. And the SAMA decided to just stop that. They forbade it. So the banks in Saudi Arabia were, to this day, very liquid. So what do you do with the money? Well, it was very convenient because it really helped them support one of their main goals, was to have the money go to industry. Now, industry was, the industry started by the chemical industry, SABIC. They went into various joint ventures of Aramco. They went into the mining companies and so on. But that's really one of the main things they could do in Saudi Arabia, the banks, in order to make money. The other big thing they could do, which helped the Saudi enormously, is that Saudi Arabia, we tend to forget, but used to have budget deficits for almost 20 years in the 80s and 90s. And that they never borrowed money overseas. And one of the main views of the technocrats in Saudi Arabia is they don't want to depend on the IMF. They don't want to depend on the foreigners. So they could borrow money from their own bank. And even though they borrowed at one point, they were almost up to 100% of GDP in state borrowing, it was all borrowings from their own banks. And so there was no interference from abroad. And that's the big difference with today, and where for the last 2 years, the Saudis all of a sudden have gone to the market in a big way. I mean, the Public Investment Fund borrowed $11 billion. Aramco announced to us in Abu Dhabi that they were going to borrow $11.5 billion for various investments, et cetera, et cetera. So the state is really changing, or the approach is changing. And there is some tension in Saudi Arabia about that, because not everybody agrees that you should become really, get yourself under the thumb of foreign institutions.
I mean, the impact of that has already been felt in other parts in the Gulf. When you start looking at the UAE and you look at the divergence, of course, it's another discussion, but between Dubai and Abu Dhabi and their investment tactics. And you look what happened in 2008. You saw in Dubai in 2008, 2009, their debt situation and their linkage to global markets led to a potential bankruptcy case or potential sovereign default in Dubai, which forced the hand of Abu Dhabi to come in and step in and effectively bail out Dubai. And in that regard, you start to see that historically you thought that the Gulf economies were completely protected against these large gyrations, but that's just not the case. And where Saudi Arabia does have massive reserves, and I think people underestimate the financial power and plus the borrowing power. At the same time, the impact of global fluctuations is now something that has to be taken into consideration. When you think about long-term investment patterns, you start thinking about the impact of building up this kind of debt to GDP ratio.
Well, and actually, just to add to that, even currently you see in Dubai, you know, I think last year it reported the largest job loss it has seen. The stock exchange has gone down quite a bit. And, you know, you see that it's starting to compete with Doha. It's competing with Riyadh, which is impacting them. And then also U.S. sanctioning Iran. There's a lot of Iranian money in Dubai. Absolutely. You know, but their market somehow still, at least, sort of seems to grow a little bit. Where do you see this going, you know, for the future of the Gulf? I mean, state is very much involved in economies. It's, as you say, if that doesn't change, it might hamper them in 30 to 40 years. If you are moving towards a diversified economy, you're going to have to be more liberal, perhaps, with your policies. You're going to have to have more transparency, privatize, et cetera, et cetera. What do you predict that's going to happen? And how, if they do not succeed, what will the impact be for the citizens of the different Gulf countries?
That's a very hard question, of course.
We're not here to ask easy questions.
Thank you. but it's interesting that really in the line of even what we were talking about in the previous question is that you take a country like Dubai or a state within the country, they had a different vision. And Dubai wanted to start an offshore center.
Yes.
So they would be the intermediary, they would provide intermediation between large funds from Saudi Arabia to industries in Kazakhstan, in Tanzania, and whatnot, and it would all meet in Dubai.
Right.
There would be a totally separate legal entity to cover the Dubai loans and so on. And it's very well done. The infrastructure is great. It's all under English law. The judges come from England for all the problems. But it hasn't worked. There are only, I think, 16 companies in Dubai which follow this, and it hasn't worked. And they spent billions really establishing this DIFC, the Dubai International Financial Center. It truly is a great place. And in fact, as a real estate play, it's a runaway success. It's fabulous. It's the best place to be in Dubai. Everybody wants an office at the DIFC, but in terms of financial market, it's just not there. And what's quite interesting is Abu Dhabi today is trying to do what Dubai is doing. Right. So, in other words, they're trying to imitate the failure of Dubai, which may not be the best way to sell it. At least maybe I'm not selling it right for them. But so it really, what's happening is what Samer pointed out in the beginning, very beginning, is that you have a big market and you have small markets. And eventually you cannot have 7 small markets. Right. You have one big market. The big market is Saudi Arabia, especially in the equity, $500 billion in capital, which compared to New York is nothing, of course, but it's still the biggest in the region. Then after that, you have Kuwait, which is highly specialized in Kuwait stocks. Bahrain has a chance at one point to do it, but they never took the right decisions. They were too late on this. And Dubai has tried really hard, and Dubai has not succeeded because, in great part, because of our Gulf Uncooperation Council, where the Saudis did not want to encourage anybody from Saudi Arabia to place money in Dubai. They couldn't stop it, because there are no rules to do that, but they discouraged it through many, many forms. So the Saudi money did not come into Dubai, and therefore there was very little for these companies to sell shares on that lack of money, so to speak. So I think to answer your question, what's going to happen in the future, I think the stock market, if the Gulf Cooperation Council gets reunited somehow, I think the markets will centralize, and it will divide a bit. I think Dubai will become much more of an investment banking center, definitely, and Saudi Arabia will be the big equity player, I think.
So I think the biggest risk to this, the downside risk to this potentially developing, is that there hasn't been, the correct way forward is a consolidation of capital markets and regulatory regimes across the region, emphasis on the latter of those, right? And what we've seen historically is that there has not been the ability or the political will to move in the direction of unifying where you need to, despite repeated lessons that you had to. TIBC is one example. International Banking Corporation is purely regulatory arbitrage between Bahrain and Saudi Arabia. The same thing occurred with the Sukhamanik crisis, and this is Bahrain and Kuwait, regulatory arbitrage. And now we see it with Abraj. And in that regard, you see repeated instances of a lack of regulatory unification leading to international financial crisis, and still no effort by the states to unify and come together to bring their markets together. So I think the professor is absolutely correct, and this is the direction we need to go in, that they need to go in, and that you need to have some kind of unification, at least discussion. I mean, when the TIBC went under, Saudi authorities fought with Bahraini authorities about who had jurisdiction, and then they each ring-fenced their respective economies. And that does not give investors confidence that there's legal recourse when things go south. It's the opposite. Right? So in that regard, what I think would be necessary before that unification is you see efforts toward regulatory, oneness, discussion to bring these regulations into order. And the first phase of this has already begun. Bankruptcy proceedings, bankruptcy law in the UAE and Saudi Arabia have both been passed and are being tested, and the VAT, the value-added tax, is also being applied across the region in a similar fashion. So it's not like this isn't like a doom and gloom panel. But this is like realistically, you have to see forward progress in this space.
To give a little more background on the TIBC,
sure,
not
yeah.
everybody may be familiar with TIBC, but TIBC was this rather large financial scandal that happened between Saudi Arabia and Bahrain, where a very well-known family from Saudi Arabia, highly regarded, called the Al Ghoseibi family, had started a bank in Bahrain, managed by one of their kin, and well, something like $12 billion disappeared. And unfortunately, the Al Ghoseibi family was on the hawk for this for quite a bit, and it never got resolved until this year, where now they have started the bankruptcy law in Saudi Arabia so that the debtors can actually be told by the judge, a judge, that they will take a haircut and keep the company going. But we spent a little bit of time on TIBC because really it all happened because the regulations of Bahrain were totally different than the regulations of Saudi Arabia, and they did not cooperate whatsoever. And we could have taken many examples of that in the book, right. But that was the latest and the biggest. And they've had hundreds of lawsuits in London, right. In New York, in Los Angeles, and right. God knows
At the end of the day, the loan book was in excess of $100 billion in fraudulent loans. But when we were finally publishing and we were getting done with this, is when Abraj fell apart, and that was a direct result of lax accounting regulation in Dubai. But to DIFC's credit, they acted very quickly, and they were very forward-leaning on ensuring that there was compliance in other areas, and that they're ensuring investors that they are taking action. So again, it's not doom and gloom, but this is an area that needs yes. Hyper focus.
Absolutely.
So maybe to bring in some positivity into this conversation, what are some of the Gulf countries doing right towards economic diversification? What kind of policies are they implementing that is actually encouraging to diversify their economies?
Well, I mean,
taxes and
taxes,
bankruptcy laws are one thing.
Yes, yes,
yeah.
They are beginning to pay taxes. They now have a value-added tax in Saudi Arabia, in Bahrain, and the UAE. And that has 5%, and people have not complained, which surprises me. They felt, I guess, 5% not that much. What they don't realize is that the VAT is a French invention. And what happens is you start at 5%, and then you bring it up little by little over the centuries, and they'll be at 20% in no time flat. But in any event, people have accepted that, and that really helps change the view of how the state funds itself. I mean, one of the biggest problems, of course, is that 80% of the income of the state in Saudi Arabia comes from oil, and you have to diversify that. So the big push right now under Vision 2030 is to have big industrial development and tourism and military factories and so on. A lot of the problem with that is there is no income tax. So the large corporations in Saudi Arabia who are very profitable do not pay money to the state. And that will change, no doubt. But until the state receives no money from the companies in general, then of course they will still depend on oil extensively. So we'll see how that develops, really. But they try to push the industrialization very heavily. Now, as we said before, they started that in the 70s.
Yes.
But now it's on steroid a little bit with the Vision 2030 and Prince Mohammed bin Salman being so eager to get this going. But now the big difference is that they're trying to bring money from outside,
right,
which is new, as I mentioned earlier.
And one of those, an area they're trying to do that in is privatization of government companies, and we have seen positive movement in there as well. And when you look at Saudi Arabia and their electric generation sector, right? They have taken initial steps to break up the power sector, basically unbundling and preparing them for privatization. These are not easy steps to take in the power sector. Blackouts and brownouts lead to revolutions. So this is not anything to sneeze at, right? But they are taking the right steps. They've broken up that part of the economy, and they're preparing to privatize it. So that is a very positive step. And ADNOC has had some of their retail operations privatized as well. So in that regard, that's a very positive step. And back on the VAT, analysis shows that the revenue generated by the VAT in Saudi Arabia is almost equal to the amount that was funneled into the citizens' account. And that's a positive use of tax revenue, right? The citizens' account is now used to offset some of the costs that people incur based on subsidy reform. So you are seeing positive movement, but it just easier to talk about the hard stuff.
I want to come back to privatization in a little bit, but first, you know, oil prices have gone down over the years quite a bit. If they remain at this price or would even go lower, like these countries still very heavily, for the majority of their economy, rely on oil or gas in the case of Qatar, you know, as a source of revenue. Will they be able to achieve their plans if the oil prices remain this way? Which is, I mean, they also seem a little bit in a rush. Sometimes I wonder whether they're, you know, doing too much too soon. But I think oil prices, like, they're gonna have to support it somehow, and so far their diversification efforts mostly are being supported by the revenue generated from oil or gas.
Oh, absolutely. But I think the view there is that, and that's very much the policy of Saudi Aramco today, actually, is to move downstream. Right. And by that is, okay, they produce 10 million barrels a day, but they have decided already, and they announced it, that they were going into refining all those 10 million barrels themselves. But the refining by itself gives always the same products, you know, gasoline and diesel and so on. But it also gives naphtha, and out of that they can diversify further down, go downstream on that, and they become very, very large value-added product productions. And the idea is that if you can go downstream far enough, then you can increase your earnings by maybe 5, 6, 10, sometimes 15 times the value of the barrel of oil. So that ultimately, you will not need to produce any barrels except for your downstream chemical industry. And that is very much on the cards, and that's exactly what Saudi Aramco is doing today. They've made a big joint venture with Dow Chemical a couple of years ago, which works. It's an amazing place. It's $20 billion investment. They have a similar investment with Sumitomo, a little bit smaller. They're making right now, as we speak, a similar investment with Total on one of the new refineries they've just built. And all their new refineries in the world, because most of the refining will take place outside Saudi Arabia, but in China, in Indonesia, they just started. They have, of course, the largest refinery in the United States is a Saudi Aramco refinery. And they're taking this downstream past just the products to go and make value-added productions into advanced chemicals. So yes, it is still based on the hydrocarbons, if you like, but the fact is they will need less and less gross production of hydrocarbon. They can, if they really were fully fluent today in this policy, they probably could earn the same amount of money for the kingdom on 3 million barrels a day, rather than 10 million barrels a day.
And that's not limited to Saudi Arabia. I mean, you also see Qatar Gas doing a very similar move on the gas side, and investing and looking to become a global company. And in that regard, like, I mean, I work in oil and gas, so I'm a little biased, right? but diversification within hydrocarbons is not pure diversification. But when you are moving away from just being an upstream producer to then creating a value chain and locking in markets through these projects, like you see in India and in Pakistan, and now with Qatar Gas in Africa and in America, you start to see a situation where these companies, yes, they are still linked to oil price fluctuations, but they are now linked to the energy complex writ large. And that's a complete different kind of dependence than one is just to oil, and one that's a lot safer, because you're going to need gasoline, you're going to need naphtha, because the plastic that we're using for these cups, that's petrochemicals, which originates from the barrel. And in that regard, it's a very different linkage. And it may not be pure diversification like we talk about at the IMF, but it is diversification nonetheless.
I think that reminds me of an important point we bring in the book, is that the financial markets are used to obtain people's approval of this type of policies. Qatar is really very interesting for that. They, a couple years ago, they created a holding company which put together all their industrial ventures downstream from gas. And they sold half of those shares, so half of the shares are owned by the Qatar Petroleum, but the other half was offered to the public in Qatar as shares. And there are only 300,000 Qatari citizens, but they have now 300,000 shareholders. Mm-hmm. And they issued the shares in such a way that people would get them for very little money. They were not allowed to sell them for 5 years. It was not just speculation. And basically every grandmother got some shares for their grandchildren, but that's really what happened. But it gave a lot of support to the Qatari leadership in developing this industrial approach. And the same was in Saudi Arabia. For a long, long time, the big firms like SABIC and Ma'aden and so on issued shares to the public, and the public bought them, and they had very good returns on that, and the public is very positive about the industrial development of those countries because of that. So the political aspect had been thought of, really.
Yeah, and SABIC was the first, right?
And they used the markets for that.
Very successful, right? And that adds another aspect to the capital markets liberalization discussion. The capital markets are not pure U.S. capital markets. The reason the state for a long time prevented foreign investment in capital markets, because the way the capital markets function is this is a mechanism for one person to move capital to another person with no state intervention. These are just open markets, right? The state doesn't necessarily like that if they want control. So for a long time, the capital markets had very strong controls by the state. Because of that, the state wanted it to be, this is a mechanism for me to transfer capital to you, not for you and you to play around. So that's why, again, when we start thinking about the capital markets and what needs to happen moving forward, the way that they operate, their objective has to be redefined a bit. Right? It's not just now about making sure that the people have a stake in the country's industry, but now it's also about growing domestic industry. So the view from up top has to change on how to use these things.
Okay, so I want to go back to privatization that you talked about in previous.
Sure.
And sovereign wealth funds. So the PIF has become one of the most important economic actors in Saudi Arabia, and has assets domestically in pretty much the entire economy. You actually say in your book at some point, and I quote, "Today, PIF is the largest investor by far in the kingdom and could be interpreted as basically crowding out the private sector," end quote. So it seems a little bit...
That was a pretty good quote.
It is a good...
Did I write this, or did you write this?
Okay, you guys can figure that one out later on. But to me, and actually you point that out a little bit in your book as well, it seems, and I agree with that, it seems a monopolistic approach that, instead of providing the local community with opportunities to build new businesses and industries. So doesn't this approach kind of work against the reforms? And is there a way that they could still push towards positive change and economic diversification even within the existing framework, to put it that way, of the PIF owning everything?
Well, and I think you're pointing out the fact that, in fact, what we've been saying almost since the beginning is that the state was really pushing for diversification and industrialization, and therefore it came from the top.
It came from the top.
It came from the top, not from the bottom, or from the people themselves. So there is a problem with that, definitely. And the Public Investment Fund is a very, very opaque structure today. We don't know who makes the decision at PIF. We sort of know who makes the decisions, but we don't really know what they look at. We know to a certain extent what they have, but what their strategy is, their strategy is to bring the technology in Saudi Arabia to give good jobs at good wages for people, but it's really vague. And they take some very big risks without informing anybody, like buying Uber and Tesla and things of this nature, where they don't necessarily make a lot of profits. And it is an issue, and it is crowding out the private sector. Even when we talked about there is an outfit in Saudi Arabia called the Saudi Industrial Development Fund, which is the development bank of Saudi Arabia, and which was basically the arm of the Ministry of Finance, just like PIF used to be. Well, now PIF basically took over SIDF for the management of SIDF, but SIDF lends 50% of any project long-term to companies. So why would the companies would pay very small fees for this loan? Why would they go to the banks? So you have a crowding out of the private sector, definitely, and that's a danger. Now, this could be resolved by pushing PIF to be more open. You know, transparency. Transparency is key.
But would the state want that?
Well, I wish I knew the answer, because definitely.
I mean, it doesn't seem like it right now.
Well, it is true that when they announced the Saudi Aramco public IPO 2 years ago, 2.5 years ago, it was very much announced that this is done for transparency's sake. The people of Saudi Arabia have to know what their main asset is, how much does it earn, and so on. And Saudi Aramco is happy to work with that because they are very well managed. And they don't really have anything to hide at that level, at the operational level. So, but then all of a sudden...
the IPO still has not taken place.
Exactly. Because there are some, we don't really know why, but in part because there's a disagreement between who owns the shares of Saudi Aramco.
Right.
And is it PIF? Is it the Ministry of Energy? And they don't see eye to eye. So the transparency issue is very important. So unless the transparency issue was resolved, then you cannot really, you will always have the state crowding out the private sector, in my view.
Do you have anything to add?
Well, I think it comes back to the fundamental theme of the text, and just one metric shows it. In both Qatar and Saudi Arabia, all the banks are majority owned by state institutions. The majority of the banks, vast majority of the banks. And in that regard, that's all well and good. There's nothing wrong with state-driven growth, but there is only so much space for free capital if it's all government capital. And moving forward, something has to give if you want the change. And it's that simple. I think the PIF is a great case study in forcing change on a existing structure and the risks therein. I mean, the PIF has repeatedly started to take on roles that, and the PIF is Saudi Arabia's sovereign wealth fund, has repeatedly started to take on roles that historically SAMA played or SAMA does play now, and PIF wants to play in the future. And in that regard, there is a real threat to the way that the Saudi economic structure is set up and how it's worked. And it's only time will only tell what happens.
Okay, let me ask one more question, and then I'll open it up for questions from the audience as well. What are some of the trends that you're seeing on the Gulf's role in the global financial market? And are you foreseeing any upcoming changes due to, sectors such as the tech sector that's been very much up and coming, or geopolitics?
Sure. I mean, we have a chapter in the book on the role of it's a good chapter of the role that the Gulf markets play in global markets, and one of the key things that we have to remember that's important to look at in this specific topic is, from a historical perspective, there has been a directionality of outward investment from the Gulf to the West that pivoted at a specific point in time. And this came after, in the early to mid-aughts, after a period of a lot of policy questions around why that money was coming to the US, Canada, and other Western countries, the UK. And while those flows have continued, you have seen in response to that a stark shift in the directionality of flows to more Eastern countries. And nobody likes the West-East divide, but we're talking about Southeast Asia, South Asia, Asia, Africa, and you've started to see that is the direction that the funds are now going, that the SWFs and all these institutions in the Gulf are now putting their money in and doing their infrastructure development, and that has a meaning moving forward, right? I think right now in this 24-hour news cycle that we're in, it's all about the Saudi-U.S. unhappiness, right? And on but it's bigger than that. It's much, much bigger than that. Because if you look at the role that the Gulf played in bolstering Western financial markets at the peak of the crisis, if there's another crisis, which there always is, markets are cyclical, the Gulf may not be there next time. They go, well, hey, we're in a different camp now, or the money isn't there, whatever it may be. So this shift in the directionality of funds has a very important meaning to the direction of growth globally and what it may mean for how the global order is stacked, right? And that's a DC thing to say, but it's reality.
Yeah, there's a lot of things happening right now that are quite different and not so far away, so long ago. I mean, the Saudis are getting much closer to the Chinese as before, and they are making some big agreements, but they already have some refineries in China. They're going downstream. SABIC, which is perhaps going to be owned by Aramco, has already some factories in China and so on. The whole notion of oil is now being questioned on the pricing of oil, where you have China is establishing a renminbi oil market, and that will make a big difference in how much foreign currency or what type of foreign currency is earned by the Saudis and the Gulfies in general. That will create another market. There's also a lot of Saudi investments, a fair amount of Saudi investments in Russia today. And Saudi Aramco wants to go big in gas, and go big in gas, yes, in the US. That's still happening. It's going to continue to happen. But also, they're taking a very large hunk of Novatek, which is a big LNG group in Russia. So it's no longer basically US-Saudi. I think that is gone. It exists, I shouldn't say it's gone. It's still there, it's very important, but it is being highly diversified now.
Mm-hmm. Okay, some questions from the audience. We have one over here, the gentleman. And please identify yourself before you ask your question.
Hi, good afternoon. My name is Benjamin Weil, up until recently the international advisor to the Israeli Minister of Energy and a common economist as well. You mentioned that Saudi will probably become an equity market. And my question is as follows, is when there were talks about an IPO for Aramco, the stock exchanges that were looked at were first New York, but then it was Hong Kong and London and not within Saudi Arabia. And number two, with the sheer size of Aramco and all the foreign currency coming in, how do you avoid the Dutch disease? Surely you can't just use the sovereign wealth fund as the only tool to avoid that.
To not quite agree with you on the stock exchange they were talking about. They were talking about, yes, New York, of course, London, Hong Kong, perhaps. But they were also going to do a fair amount on the Tadawul in Riyadh. I think that was always the intent. In fact, frankly, it's a mere $100 billion, right? So they could have done the whole thing in Riyadh. The problem of that is that then they would put the company as capitalization of the market, which is $2 trillion, which would be 4 times the present capitalization of the market. So they couldn't really do that at this point. But cash-wise, they could have done it. So that's all I wanted to say on that. Samir, you might want to finish the answer. Or?
I think For the most part, what we've seen in the region as far as preventing the Dutch disease that you speak of, it has been primarily the role of the sovereign wealth funds. I mean, when you look at the sovereign wealth funds, they're crisis response units. QIA most recently during the embargo, the KIA in Kuwait during the Gulf War. So this is what they do. They are probably the best at it in the world, bar Norway. That is the mechanism they have. Will there be a shift in that regard? I mean, there's bureaucratic stagnation in these kind of things. I don't foresee it. And I would think the money, in fact, the money is now, the argument is now, does the money go to PIF or SAMA? So in that regard, I mean, it would be the same mechanisms, I think.
Lady in front, right now.
Dana Taqawi, Bahrain Embassy. I have two questions. My first would be for a country like Bahrain that is not as oil dependent as the other Gulf states, how do you see the future trajectory of the economy and the diversification? And my second question would be, for an alliance like MESA, if that were to happen, do you think that would have any effect on the Gulf economies in the region? Thank you.
Well, maybe I mean, the oil discoveries and the gas discovery in Bahrain just early this year, I think, at least announced this year. It could be a game changer for Bahrain, definitely. But as we discussed, in fact, we were talking about that earlier today, doing shale gas offshore has not been done yet, and it would be first if Bahrain does it. I know they've hired Halliburton to do this, but it would really help Bahrain, because Bahrain today is totally dependent on Saudi Arabia in terms of oil. Most of except for the 35,000 barrels down in the center of the island, everything else comes from Saudi Arabia directly or indirectly. So that is difficult, but. If Bahrain is able to get the gas out, that would be a very big plus. But it's going to be expensive gas. So the amount of money Bahrain will make out of this is probably not as much as we think. I think some experts said that if the reserves are X barrels or X cubic meters of gas, you will only get at the end 5%, which is 5% of a lot is a lot. So that works. But that will help Bahrain to be less dependent on the Saudi economy, for sure. So.
Yeah, I mean, I think, unfortunately, the Bahrain economy is in a tight situation. We've repeatedly seen the attempt to tap global markets, debt markets, to shore up domestic finances, and that's only been successful because of the support of, or the underwriting of their neighbors, right, and the hydrocarbon support from their neighbors as well. So these two aspects, coupled with the tourism flow from Saudi Arabia, these are the kind of the key movers, the key drivers of the Bahrain economy. And there has to be two things have to happen for there to be I think a change in trajectory. The first would be, we don't talk about this much in the book, but and it goes without saying, there has to be a shoring up of domestic financial spending. Like, you can't just, you have to reform your spending, right? That's point one. But point two is that you would see Bahrain domestic economy develop a specific niche for itself that differentiates itself from the rest of the region. And we saw an attempt at this. And you start looking at Islamic finance and Islamic financial regulation, Bahrain did a lot of work to become that center. I mean, the way the cookie crumbled was that the UAE became the center instead. But Bahrain tried, and they made a very good effort, and there's a lot of institutions there who do a lot of Islamic financial regulation, policing, and issuing in Bahrain. And in my opinion, to see success, to see a divergent path, one that is not dependent on underwriting of its neighbors, or a very difficult to foresee shale find in Bahrain, which is extremely expensive, there would be a double down effort on creating some kind of enclave for itself that specializes on something that the other regions don't. It could still be Islamic finance, but there has to be a hyper-focus to get one thing and get one thing right. And we haven't seen that so far.
Yeah, I mean, Dubai, for instance, became the center for the investment banks. And that was, you know, Bahrain at one point became very big in private equity. I mean, they have the best private equity company in the Gulf is Investcorp, and it's based in Bahrain. It was started in Bahrain, but they have not been it has not developed further than that because the UAE and Dubai in particular was so keen on on stealing the business, so to speak, and have been very successful at it. So, but Samer is right. The problem is to find the right niche, and Bahrain has always found a niche. You know, in the 70s, they became the big foreign exchange center of the region. Then that went away because of the technology. They became the suitcase bankers of the region, and that worked very well for 10 years until the Saudi banks became very, very able to do as good a business as anybody else. Then they went into Islamic banking because the Saudis did not like Islamic banking. It might be hard to believe, but they really didn't. And they fought it tooth and nail for years. And then all of a sudden, they decided it's a good idea. If Bahrain makes money, we'll do it. And they started opening up all the Islamic banks in Saudi Arabia. That was very successful. The business in Bahrain sort of dried up a bit. So the investment banking went to Dubai. The private banking was a big thing. But that also went to Dubai. So, you know, there are things, I mean, you know.
Okay, we have a question from the gentleman, second row in the back on that side.
Thank you very much. My name is Naeem Khanjani, Middle East analyst. As you mentioned, the economic challenges for UAE and Dubai in particular, as last year had a big job loss, of course, competing with Doha, Riyadh, and sanctioning in Iran sanctions, and also oil price drop. But also what we didn't discuss was that the country is in war with Yemen, and they're spending so much money. So what are your thoughts on how much this influenced the economy of the country? Thank you.
I'm going to let you take that one.
Well, we don't know how much money is being spent on the war in Yemen, for sure. And definitely the spenders are the UAE and Saudi Arabia. There's no doubt about that. The others are not really spending. Qatar is not spending much on the Qatar issue, on the Yemeni issue. So it does have an impact, not so much in terms of money. It's big money, but I think it has an impact mostly in terms of the atmosphere for potential investors. I think a lot of the larger companies would say, I've met some companies in the Far East who were strongly invited by the Saudis to put some plants in Jizan, because, you know, Jizan is now one of the largest refineries in Saudi Arabia, just started this year. And they want to go downstream on that in heavy chemicals and advanced chemicals and so on. And they were looking for Far Eastern companies to invest. But these Far Eastern companies see that there's a war literally within, you know, 100 kilometers. Mm-hmm. And they're not really eager to get rockets coming down on things that tend to explode in the middle of the night, you know. So that has been a problem. That is a problem. And the war in Yemen, I think, is slowing down the ability of foreign firms to really make big decisions, even if it's not for Jizan, even for the rest of the place, because, you know, it points to less stability than there should be.
The gentleman in the brown jacket.
Thank you very much. Mushtaba from Inclusion Forum. Do you see any effect of cryptocurrency on the monetary authority in the Middle East, and how it's going to change
That's interesting.
some of this?
We were talking about this the other day, actually. It's
we didn't really write anything about it.
I did. I mean, I did. I just didn't show it to you.
Ah.
Okay. I think. So I think like it's an interesting question, especially. So in my capacity with S&P, we did a lot of work around new technologies and how they affect trading environments and how they affect financial environments, especially blockchain and cryptocurrency and tokens. And what we've seen is that there's a huge lack of desire for major players to take action if there isn't a strong regulatory environment to ensure that the action is guided and not just roaming randomly. And I think in that regard, what you don't have in the region is a strong regulatory environment that allows for people to come and say, I'm going to set up shop here. I'm going to do all this new tech, and I'm going to be protected if something happens. You don't have that, and that may hinder. At the same time, you're asking about cryptocurrency that has the other side of it, which is non-traceable, and which is not, and looks for places where there isn't regulation. And in that regard, I think the risk that the Gulf has is the same risk everybody has. It's not specific to the Gulf. It's no secret that illicit funds and semi-illicit funds find their way to places in the Gulf at times, and just like they do in a lot of places across the world. It's not a specific thing. So I don't think that the cryptocurrency has an answer that's specific to the Gulf. I don't think it will inhibit I don't think that you'll see real investment in new technologies in the Gulf because you don't have the regulatory environment necessary. We've seen efforts in Bahrain to do so, and the UAE to create like sandboxes where you can come and, hey, it's an incubator, but the environment just isn't there to make it happen. It's more likely to happen in Egypt, frankly, but than it is to happen in the Gulf, and it is happening in Egypt. As far as cryptocurrency goes, I don't think they have an advantage at all.
Okay, the lady right next to you, actually.
Hi, Varsha Kodavayar from Foundation for Defense of Democracies. My question is, how long do you think GCC economies can continue tapping debt markets before it becomes unsustainable or before it becomes a bigger problem? I think right now, and maybe through the medium term, it seems like there's a lot of investor appetite for Gulf debt. I think they see GCC as a good emerging market bet, but how long could they keep relying on that, especially in Qatar, the UAE, and Saudi Arabia, before it becomes unsustainable?
I didn't quite understand the question.
Yeah, I mean, I think so as far as how much debt the Gulf can take.
Debt.
I mean, when you look historically, and the professor rightfully noted this earlier, we saw debt to GDPs of 100% plus in the past. We're nowhere near there in some of the in the larger countries. But where you do see an issue is countries like Bahrain, where you already see a reluctance by global players to take on more Bahraini debt without the guarantee from other countries. So that I don't think personally. I think people underestimate the firepower that some of the bigger countries have. They can, and people know that, right?
Yeah, that's true. I think I'm sorry, I hadn't quite heard the question right, but there's one of the big changes that has taken place. I think we mentioned that a bit earlier. Is that now the countries seem to be quite eager to borrow international debt, which they were not, especially Saudi was not. Now they seem to be borrowing quite a large amount of money. There are some talks that Saudi Arabia is going to look for $70 billion to finance the purchase of SABIC. And I don't see that happening, frankly. I think it's too big from a purely analysis standpoint, a credit analysis standpoint, it's okay. There's enough capital, but it's a big amount of money for the markets to swallow. And but that's a change. And I think as long as people realize that 16 million barrels a day go through the Straits of Hormuz, that there will be money flowing into those countries. So the large banks, even after the Khashoggi affair and after all that, they're still willing to lend to Saudi Aramco $10 billion or $11 billion. It shows that, you know, their credit review shows that the countries can still take some debt. Now, some countries can take more debt than others. Definitely, I'm afraid Bahrain would have problems raising very large amounts of money, but the UAE would not, and the Saudi Arabia would not. But there are there was an article today in one of the think tanks published on that, and the lady there who wrote about that, who's very knowledgeable, thought that the Saudis were really going overboard in terms of how much money they're borrowing. And considering the past, yes, as I said, they never borrowed money until now, and that's a big change. You go from 0 to $30 billion in 18 months. That's a lot of money. You know, so I think there's capacity to take more debt. There would be more capacity if there were less tensions with Iran, if the war with Yemen was finished, which is the same thing, the same issue. And so I don't think we can make an absolute judgment today. A lot of it is political decisions have to be made. Then the debt can flow much more, I think.
Okay, we have a question here from the gentleman in the front.
Robert Schroeder, international investor. Regardless of one's policies on this, the general agreement that the world temperature is rising. We're seeing a number of Western countries making commitments to try to move to electric car technologies, et cetera. Not that that'll make a great bit of difference, but now we see Saudi Arabia investing in nuclear energy. Is it a signal that they think that there's at least some place in the distant future where they can expect less revenue from oil and natural gas?
I don't.
Go ahead.
You sure? Yeah. I don't think. I don't think there's a link. I'm a full believer in climate change. For the record, nobody misunderstand my answer. But I don't think there's a link. I think the reason Saudi is looking for nuclear reactors is because other players have nuclear reactors. I don't think there's a link otherwise. I mean, yeah, that's.
Well, they had plans, 2 years ago, they had plans to invest in, I think, 16 nuclear plants. Right. And they're down to 2 now. And in fact, a lot of people are saying, in fact, they're down to 0 because they've decided at the highest level of the Ministry of Energy that nuclear energy is fine, it's good, but even the UAE has 4 plants in construction and they're not able to start them.
It's a huge issue in the UAE.
That is not worth the money, it's not worth the political troubles. So we're going to go big, big, big in solar. And they are really going at it right now. But this is new. This is really brand new. About a year and a half ago, you never saw the word solar anywhere, but now it's everywhere. And there are articles, and their big issue is always in solar, as everybody knows. It's how do you store? This is a storage issue. And I think they work very hard on that. So they are quite aware that in 50 years, there will be a big shift in usage, in demand for oil. That they see that, and they know it. They've known it for a long time, but it's still they're not worried about losing their market share tomorrow. Let's put it this way. But they are investing a great deal in solar. The UAE is also investing a great deal in solar. But they are the first ones to suffer. There's a book that was just written by a scholar from Texas a couple months ago, which said that these people in the Gulf will be the first ones to suffer. So they want to produce more oil to make more money, but if they do, then their water is going to rise faster and Dubai will be gone. I mean, so they know that. They're very, very knowledgeable about that today. So, but they have no solution yet.
I mean, the one country that's done a lot of forward action in shifting the way that they generate they produce their fuel would be the UAE. And you look at KSA, they have 300 odd megawatts of solar capacity. That's literally nothing, right? They have massive plans to grow that solar capacity, and as the professor highlights, that shows the recognition that there needs to be a shift. But the UAE, on the other hand, has already done a lot of this shifting, right? They have a lot of solar capacity, and they've pushed very hard on nuclear. There are a lot of issues with the nuclear plant that they're trying to bring online, issues around regulatory licenses not being in order, delays in construction. They're 3 years behind. They're supposed to be another 2 years behind before they ever come online. So in that regard, Saudi Arabia looks over and it says, hey, look at how difficult it is. It's really difficult. Why don't we do solar? The UAE's been successful. They've done it. They have a lot of solar capacity. They have more coming online. And they're going to try to copy. On that note, when it comes to energy and energy mix, there's a huge shift coming. I mean, they are at a point where they need a lot more natural gas than they currently have. They have to shift away from their current generation, their power fleet, away from high sulfur fuel oil and oil to more cleaner fuels. And you're starting to see plans for that shift, but it's going to be a pain point in the next 10 to 15 years that we need to watch, that they need to watch.
And I think to go into your field, really, I think the big effort right now in Saudi Arabia is to go towards gas. They know that it's going to take another 30, 40 years to really get enough electricity out of their big plans for solar and wind and all that, but mostly solar. So now right now they're really pushing very hard on gas, and they know that they were always weak. That was the weak link of Saudi Arabia, is they never produced enough gas for their growth. And now they found a lot of dry gas, but it's full of H2S, so it's a very expensive gas. Now, one could dare suggest to the Saudis that maybe they could buy gas from Qatar.
Don't you dare say it.
Or even from Iran.
Mm-hmm.
You know, the Iranian fields of gas are closer to Saudi Arabia than they are to Iran. So it's really, it would be there are possibilities. But now they're on a big war path in Saudi Arabia to go get gas somewhere else. So they want to make LNG in the south here. They want to make LNG in Novatek in Russia, import LNG to Saudi Arabia. I mean, that's the big talk. But that can happen very quickly. They can use gas. They can become gas fluent, if you like, within a few years, while being totally good in solar will take many years.
Right.
But they do have an advantage, is they're getting very close to the Chinese. And of course, the Chinese are the biggest in the solar business. And I think we will see some results there.
Yeah, absolutely. And oh, you know, we'll take the next question.
Yeah. There's a question from the gentleman in the back of the back.
Stanley Kober, I'm an MEI member. We've been talking about Saudi Arabia and the gas and fiscal problem. But Saudi Arabia is trying to diversify its economy because it can't rely on gas anymore in the future. That's what the Project 2030 is all about. I'm looking at an IMF report published last year. It focuses on Saudi Arabia's unemployment, particularly college level, college graduates. Most of the unemployed have some level of education. 52% have a bachelor's degree. Women with tertiary education constitute the vast majority of the college-educated unemployed. Long-term unemployment is also high. How does Saudi Arabia diversify its economy if it cannot create jobs for its college graduates?
That's the key issue at hand, and that's the one that they're trying to solve to Vision 2030. The difficulty is not creating jobs, but it's creating high wage jobs, not just any jobs, right? And at the moment, what you've seen is a stringent, strong, forward-leaning effort to decrease the dependence on foreign labor, but what the effect of that has been is opening up space for jobs in lower wage areas, right? So what we have, this shows two things, okay? The first of it is a recognition that action has to be taken and a movement in that direction. Another recognition of that is the loosening up of laws around women in the workforce. So in that regard, there is a recognition and effort towards looking at these numbers. Second, though, what it shows, and this is on the negative side, is that those actions aren't nearly enough. And there has to be more forward-leaning, more widespread action to bring high-wage labor to the country. So in there, you also see efforts at knowledge transfer, attracting high-caliber investment. And unfortunately, over the last 13, 14 months, that's all been taken astray due to some foreign policy decisions. Right? But at the same time, what I think is important to keep in mind is that transitions are time intensive. And I think it's important to recognize that even this discussion about women in the workforce and the changing dynamics around that 10 years ago wouldn't have been on the table, right? So I think, yes, I think it's absolutely correct that the numbers are horrifyingly they're hard. They're hard to look at. But progress, not perfection, in the medium term. And if you don't see continuous effort, which I worry you won't, that's when I think it's time to say, hold on a second, like, what's going on? And we're almost there. But as it stands, I think you do see some signs of recognition and some signs of movement. We need to keep our eye out for more of it.
I'm not sure I agree with Samer on that. We very seldom disagree. I think, PIF, that's what they're trying to do by buying Uber and Tesla and all these things I mentioned, because they're trying to bring bring technology to the kingdom by learning the technology overseas and therefore creating good jobs at good wages and so on. But that will always be a relatively small percentage of the total workforce. I think the biggest problem of Saudi Arabia is the foreign employment, foreign labor. You have 10 million foreigners living in Saudi Arabia who would take most of the medium quality jobs and the lower quality jobs. And it has not gone to the Saudis because it is the private sector in Saudi Arabia, which is still 80% foreign, manned, is too attractive. Why would you hire a Saudi? If you want to pay a Saudi a good wage that he can have a family, it has to be maybe $50,000 a year. Why would you hire a Saudi for $50,000 a year when, legally speaking, you can get an Indian for $5,000? And this just doesn't happen. And as long as, so in fact, they're very much aware of that, and they've created a whole bunch of very complicated systems because the lobbies, it's a country where lobbies, like here, are very important. The private sector lobbies do not want to get rid of their foreign labor. They don't want to have Saudis because they have to be nice to them and so on. So it's a big problem. What's happening, though, is that little by little, the government is really tightening the noose on the visas. There's been over 1 million foreign workers have left Saudi Arabia in the last 2 years. And what's happening now is that when you go to Saudi Arabia, you will see in a lot of places, fast food restaurants, hotels, and so on, you'll see Saudis manning the desk, which 5 years ago you never saw. But that is increasing the cost to the private sector, which can be a problem because if you do that, that creates inflation. So they have to go step by step, but now there's a lot of problems because the smaller companies, who are the ones the most dependent on foreign labor, are the ones who have to pay the money, and they are complaining. So they are trying to keep the status of these foreign workers for very little money. So it is true that by opening the workforce, as they have actually to women, that has helped a lot. But it is just the very beginning on that. And as Samer said, it's one step at a time here. But they have a long ways to go. Yes, there's people that go to university, especially women, and they come out with diplomas that are not really always useful. But we do the same here. I mean, anyway, I think the key is not so much the high-paying jobs. Yes, that's very nice if you can do that, and we will do that, no doubt. I had many Saudi students here in Washington, and I can tell you these people were really eager to go back home and create companies. Everybody, they are really great at thinking, how are we going to make money for this? How are we going to make this here? We're going to bring this company from here. They're really entrepreneurs, and that creates jobs, definitely. But if you're an entrepreneur, a young Saudi entrepreneur, you say, okay, I'm going to start this little company, but I'm only going to hire Indian technicians because then I can make money. And that doesn't work. So, we'll see how that continues. But there is a massive effort to change that. But it will take a lot of time, and it's very wrenching for society. Very wrenching for society. In Bahrain, they had the same issue. At one point, they had this whole system where they were going to put a lot of taxes on the foreign workers, and so that people would hire Bahrainis. Well, the people who fought the law the most were the small Bahraini merchants who wanted to be able to get their very cheap labor and not depend on having to pay taxes to the state. So the law basically became moot. So we see this kind of issues. It's sort of self-feeding. Now, I'm not hopeless at all. I think, in fact, knowing my Saudi students, so to speak, I feel very strongly that they will succeed. But it is going to be very difficult.
I don't think we disagree at all, actually.
No? Okay. Good.
Okay, we'll take one more question and then we'll close.
Thank you very much, and my name is Satoru Toyomoto, General Manager of Jogmek Washington office. And thank you very much, and very impressive for us. And I'd like to one question, and what do you think or predict the impact of the trend of increasing domestic energy consumption, especially crude oil in each country? So because the population is growing and the lifestyle is changing, and so you can mention the industrialization will be succeeded, and also what is the impact of the energy consumption in the domestic in each country to financial market in the GCC and the financial power in the GCC. Thank you.
I mean, sure. Over the last 6 years, there's been a huge discussion about this idea of crude burn in Saudi just to generate power. And actually, the data shows it's declined significantly over the last couple of years. And there is a recognition that domestic energy consumption can be a stymie to growth, and it's very costly, if nothing else, opportunity costs of barrels you can't export. But I think when it comes to what is being done, the subsidy reform across energy price reform in the UAE and Saudi Arabia and Kuwait, these are not small measures. They are very painful to people who for decades have taken free energy as a given. So I think in that regard, there's a huge recognition that there needs to be a greater emphasis on efficient energy use, and you've already started to see that specifically in Saudi Arabia over the last 2 years, just because of the way they've done subsidy reform. And while I think that it could be somewhat expensive from a like an opportunity cost, the broader impact on financial markets is limited, right? Because how could it impact financial markets other than making some specific companies largely less profitable? So I think the most important bit of this of that actually is not about financial revenue, but is about climate change and ensuring that the ways that they do generate electricity and that they do generate power is efficient and cleaner than burning fuel oil and crude, which is just insanely inefficient. And you've already seen a shift in that direction.
Okay, thank you. Do you guys have any final remarks before we end this?
No.
I mean, it's been a pleasure.
It was a pleasure. There are a lot of fun parts in the book, by the way. It sounds very serious.
I do recommend that you purchase the book. It's available online, The Financial Markets of the Arab Gulf, Power, Politics, and Money. Thank you so much, Jean-François. Thank you so much, Summer. Thank you.